Hi, my name's Nick Griffin from Munro Partners, and I'm here to talk to you about the investment process that we've built here over the last 13 years that we've been working in international equity markets. The key and most important thing about our investment process is that we are growth investors. Our job is to find growth companies that can grow or shrink at a more sustainable basis than the peer group. We do this most importantly by focusing on earnings. And so our investment philosophy has three overriding principles. One is that earnings growth drives stock prices. We generally find that any company that can make more money every year, we generally find its share price goes up. Two, we think that sustained earnings growth is actually worth more than cyclical earnings growth. And lastly, and most importantly, we find that the market often misprices growth and its sustainability. What I'm showing you here on these two charts is on the right-hand side, I'm showing you the share price of Bank of America over the last 10 years. The black line is the share price and the blue line is the 12-month forward rolling earnings expectations for the company. And on the left-hand side, I'm showing exactly the same thing for MasterCard. And the first thing you'll notice is their share prices are effectively following their forward EPS expectations. The second thing we'd say is that we probably don't have a lot of value to add on where the earnings of Bank of America are going. It relies a lot on macro indicators, interest rates, regulation, etc. But on the left-hand side, MasterCard, you can see, is benefiting from a simple shift from physical to digital cash. This is a structural shift, creating sustained earnings growth over a long period of time. What's interesting about this slide is I think most people know this. In fact, most people have known this for quite some time. Yet the market is incapable of pricing it in. And the reason why it can price it in is because it's accelerating. And so that's our final point. The market always misprices growth and its sustainability. And the reason why that happens is because most of the market believes in mean reversion. And our job at Munro Partners is to find the situations where mean reversion doesn't exist. So how we do that and how we've done that over the last 13 years is to focus us on our core secular universe of global growth stocks. And so what we're showing you on this chart is that many years ago, we worked out in the big bubble, there was 24,000 companies in the world with a market cap above $100 million. Within that 24,000 companies is a whole bunch of companies that profess to grow. And they're always growing usually because of macroeconomic events, be it GDP will be better, or this commodity price will be better, or interest rates will be higher. And all of these things, while potentially could occur, are notoriously hard to predict. But on top of that, we'd found we didn't have an edge in predicting those things. We have a view, it's just our view's as good as someone else's. And so what we wanted to do was focus on where we could find an edge. And so what we spent the last 13 years building is this smaller secular growing equity universe. We have it down to under 1,000 stocks, and they generally come across these different areas of interest that I'm showing you on the right. And I think a lot of these are fairly obvious also. So if you look at e-commerce, for instance, e-commerce is only 10% of all commerce today. It's clearly continuing to grow share, hence it's growing at roughly 13% per annum. 10% share of all commerce will probably grow to 30% over time. And so this is an obvious place to look for structural earnings winners. We also obviously see the same thing happening with the internet, where disruption has been occurring over the last 20 years, creating large structural winners, but also in now new areas like healthcare or potentially the food and beverage revolution. The second part of our process is the qualitative and quantitative tests that we put all of our companies through. And so to find these 960 companies, we've generally either met them or met their competitors over the last 13 years of running money. We're doing over 300 company meetings a year, and every company meeting we go to, we're essentially trying to tick off these 5 qualitative traits. If you have these 5 qualitative traits, you're generally going to be a great growth company. And the first and most important one is growth. So is your whole market growing? As I said earlier, e-commerce is growing at 13%, so any company in that industry is growing, and usually in line above or slightly below that number. That's a tick. Investment banking, on the other hand, is shrinking. And while there might be some great investment banks to invest in the world, we put that down as a cross, and we're more than happy to leave that to other investors in the marketplace. The second and most important test is, can you leverage that growth? Well, some e-commerce companies can, and some can't. Generally, we then will look at the market position of the companies we're looking at. Thirdly, is the growth sustainable? Well, in e-commerce's case, we think that is the case because we see at least another 5 to 10 years of e-commerce taking share from regular commerce ahead of it. And last two are most important ones. 4, do you have a large controlling shareholder or highly aligned management? And 5, what's the customer perception of your business? We find time and time again these leaders to these very few winners. Often we have situations where you find large structural growth trends, you find a lot of potential investments, but it's always the one with the highly aligned management and the greatest customer perceptions that end up winning. The best example we always used here is the smartphone market, where at the start of smartphones in 2008, there were potentially 10 investments we could have invested in. Yet 8 of those investments didn't make it, be it Nokia, Ericsson, BlackBerry, Motorola, etc. 2 did, Apple and Samsung. And both of them had that important controlling shareholder who was militant about the customer perception of the product, positioned for growth, sustainability, and in Apple's case, turned it into the largest company in the world. You can see similar traits at Google, Facebook, and Amazon, but also even among smaller companies that I'm sure many of you invest in today. We see it in most of the countries we look for. But these are the key qualitative characteristics we look for to get into our universe of 963 stocks. What we then do is we build on the right here, we're showing you these areas of interest. So this is just a better example going into more detail of an area of interest. We have a basket of potential winners here. These are just a cross-section of some of the companies that sit inside our universe. And it's important to remember there are sub-trends that could potentially appear here. And these are the companies that we want to do work on. The third part of our investment process is the idea of valuation, the quantitative side of our process. Here we build our own in-house models, which essentially identify structural earnings growth, usually significantly above consensus. We then also set a multiple target based on our qualitative view of the company, and we identify catalysts. The companies we're looking to invest in, we're looking for them to double within the next 3 to 5 years. So that's a minimum of 15% per annum return, and we need to be able to mathematically prove that before we can put it in the portfolio. The last part of the investment process is putting the portfolio together. And so here we're looking at portfolio construction and risk management. The key difference here, I think, with many products is we use stop losses. We generally find stop losses work well as a review or a reaction function within our long-only portfolio. So if any company we own falls more than 20% from peak or from cost, it is subject to a review. That review is done in the investment team meeting, of which all members of the team are present, and whoever is responsible for that stock needs to defend it to the entire team. If one person in the team decides we should sell the stock, then it is taken out of the manager's hands. What generally happens is we generally unanimously agree to keep it, but we can only keep it for 30 days. And then if it's still triggering, we review it again. And in 30 days' time, if it's still triggering, we review it again. And eventually you work out that you've actually got the wrong stock. This is a reaction function. Eventually you work out you bought BlackBerry instead of Apple. And so not only do you avoid the losses, but it also leads you towards the eventual winners. And what it creates is the picture we've shown you on the right here. On the right, we're showing you our top 10 winners since inception and our top 10 losers since inception. And what you're seeing here is we're generally trying to have our winners significantly outweigh our losers. Equities is a great place to invest. Stocks can go up thousands of %, yet they can only fall 100. So it's asymmetrically in your favor to invest in equities. The problem is more fall 100 than go up 1,000, and that's why we use stop losses to help us avoid those situations. The last part of our process is to manage liquidity and to monitor correlations. And most importantly, we do set price targets on all of our companies. And so the goal is to hopefully sell them at their price target, not sell them when they eventually trigger on a 20% fall from peak. So to summarize, equities is a game of very few winners and lots of losers. You find those few winners with structural growth opportunities. And so that is where our universe focuses. We have a universe of less than 100,000 stocks that focus on the key areas of structural growth. Generally, we find the key winners within these structural growth share the same qualitative characteristics, and we measure each company on these qualitative characteristics. It helps lead us to the winners within the structural areas we focus on. Thirdly is the maths. Every idea has to add up by the maths and has to mathematically equal a doubling over 3 to 5 years. There are lots of good ideas in the world, lots of good stories in the world, but most importantly, they need to mathematically add up. And lastly is the portfolio construction. The goal here is to find a range of different areas of structural growth and a range of different structural winners that will not correlate to each other over time. And importantly, our stop losses here help us avoid those many losers and lead us towards those few winners. And all of this together has enabled us to achieve the strong returns we've seen to date, and hopefully will continue to enable us to learn and discover where the great structural winners of the future may lie. Thanks very much for listening.